Okay, according to the Center for Retirement Research at Boston College, the downturn in the stock market has wiped out $3 trillion in retirement savings. That's trillion with a T. Is the bear market a sign of an impending recession, or are we already in one? Moderator Susan Godot welcomes a distinguished panel of Oklahoma economists to discuss that in this week's in-depth conversation.
Thank you, Rich. Yes, the economy is top of mind, not only for Oklahomans, but for Americans. And we have some top minds to help us address that subject here with me today. I'd like to introduce them to you now. We have Dr. Robert Doffenbach, who is a Senior Associate Dean for Economic Development at the University of Oklahoma. We have Dr. Travis Roach, who is an Associate Professor and Chair of the Department of Economics for the University of Central Oklahoma. And then we have Associate Professor of Economics, Dr. Benjamin Keene, also from the University of Oklahoma. Thanks to all three of you for being with us.
Glad to be here.
Glad to be here.
Well, let's jump right in, gentlemen, and we're going to begin with Dr. Doffenbach. Dr. Doffenbach, will you define, we keep hearing the word, we might go into a recession. First of all, what is a recession, and do you think one is looming?
A recession is when you have, as technically defined as 2 quarters of declining output, real output at the national level. But certainly, I think one of the key factors in defining a recession has been whether or not the unemployment rate is growing and labor market conditions are deteriorating to a substantial extent. Well, there's about, according to what I hear in the press these days and just kind of measuring sentiment, I think there's about a 50-50 chance of a recession in 2023.
Dr. Roach, to that point, talking ourselves into a recession, the more we hear negative, does the impact on the American or the Oklahoman psyche impact how we buy, how we purchase? If we hold back, does it contribute to the cause?
Sure. Consumer sentiment is one of those things that is the most difficult to kind of project and anticipate. But honestly, some of this, if there is any kind of, let's say, tapping of the brakes here, this could be just a response to higher prices, which is, in fact, the market economy working the way it's supposed to. The consumers are responding to higher prices by pulling back their demand a bit. And so am I worried that this is going to push us into a recession? No, I'm really not. However, you're right, though. The consumer sentiment matters. And if we keep echoing this to each other, there is this self-fulfilling prophecy version of this story that comes true.
All right, Dr. Keene, I do want to ask you, as you've sat and watched all of this, how does this point in time, economic activity in this point in time, measure up to what you've seen throughout your entire career?
Well, the economy is stronger than it's been really in a long time. So we're starting at a very strong point. We're at 3.6% unemployment rate. We've got really 2 job openings for every worker that's out there. And that is that's flip-flop from what we normally have. In normal times, we have we have 2 workers for every job. So there's a lot of slack in the economy in terms of if we have a period of economic weakness, we could see a world where we start to see job openings become more in line with where they are naturally, and that we would have that in lieu of having job losses.
So we talk about, okay, the economy is strong, but everything's so expensive. And sometimes you go to stores and not everything is there. That doesn't feel strong to the average consumer, the average Oklahoman. What is missing? Where's the gap?
Well, I think that we have to recognize that we are in still some very precarious times. We've got war in Ukraine. We've got energy shortages. We've got a Fed that is very persistent in saying they want to get us back to a 2% inflation rate. That's not going to be accomplished very easily. And we have to recognize that these are difficult times. We're looking at 10.4% increases in food prices year over year, a 34.3% increase in energy prices.
Dr. Doffenbach, I do want to ask you the same question I asked Dr. King. You know, in your career, how does this point in time economically measure up?
Well, my career spans a little bit more time than these.
Might be why I asked you.
and looking forward to the end of my career, actually. But I've been around following national economy since graduate school in the 70s. And I can tell you that we're going through a phase now that is quite similar in many regards, in the energy front in particular. And I'm afraid that I see too many parallels with the 1970s leading into the 1980s. The Fed has a real tough job on its hand, in its hands, to try to bring demand down and bring inflation down somewhat too. I think gasoline prices will have probably peaked out and will be coming down a little bit. And when you inflation adjust, it's not like we haven't seen $6 gasoline in this country, which we did in 2014, but has always come back as well. So there are a lot of challenges there.
Well, Dr. Rich, one of the challenges is when I got my 2022 first quarter report for my 401k and nearly had a heart attack. Please explain why I shouldn't panic.
Because you're nowhere close to retirement age, if I might say so myself. And this is actually, stocks are on sale. Think of it that way. We're more likely to go buy something on sale at the store. This is just lower price stocks for you to go and purchase. This is, if you are not so close to retirement age, this is actually an opportunity for you to, if you have it, put some more money into your retirement account so that it stands to grow a little bit more than if you had bought them at the prices we saw just half a year ago.
Dr. Dolphinbeck, I want to move to the interest rates that you mentioned earlier. Do you think that will affect spending? Whenever I address an issue that is of top of the mind nationally with the national media, and then I talk with our people here on the ground in Oklahoma, I tend to get a different picture. So I just want to ask you, Dr. Dolphinbeck, is this being hyped, and is the interest rate going to be a really bad news for the economy?
The interest rate definitely demands careful watching. One thing that history tells us, looking back at all major episodes of inflation since the Great Depression in this country, and some occurred immediately after World War II, of course, we had quite an inflation there as well. But my point is that nowhere in our past have we seen a condition where the interest rate isn't higher than the inflation rate.
So another thing, Dr. Roach, I want to come to you since you have a background in energy economics. Let's talk about those gas prices that were just mentioned. Do you think they will come down, given the state of affairs that is particular to this point in time, with all of the problems with refining, transferring natural oil products? What are your thoughts on this?
Sure. Well, so the prices will drive new investment. That's how this works, right? What we're seeing is really the delayed effect of reduced capital spending a year ago. Because if you'll remember, just a little over a year and a half ago, West Texas Intermediate prices dipped into the negatives. And so that puts a major hold on any new investment. And these things don't happen overnight. So just for new supply to come online, there's a considerable time lag. And then add to it, we see some issues with refining. And then also a lot of we are what, I think the Independent Petroleum Association was recently on talking about energy independence. And if we define that as exporting more than we import, then we've been energy independent for a few years now. We're currently energy independent. And part of the, I'll say problem, I don't know if it's a problem, we're exporting a lot of raw goods and finished goods to European markets to help with their energy crunch there. And we're doing that because the prices can command it. There's a higher price that can be earned there than here. And so that's going to draw some of the domestic supply out of our country.
So Dr. Keene, after listening to all this, I do want to ask you, first, as the president says, recession is not inevitable, which is always a tad little twist, double negative there. Do you agree? Do you disagree?
Well, the only things that are inevitable are death and taxes. So we can avoid it. The thing is the Federal Reserve is in a process of seriously fighting inflation. They've been late to the game, and their attitude, or at least from what I've heard from Fed officials, is we're going to take care of the problem. We don't care what the source of the inflation is. but we're here to take care of it. And they're very conscious of the fact that inflation expectations in terms of higher inflation down the line in the next couple of years is going down. But if the Fed doesn't come through, then they're going to lose that control over inflation, the narrative that they had since the early 1980s. And if they lose control of that narrative, the economic cost of bringing inflation under control will be a lot higher because the Fed will have to raise interest rates higher and for longer.
Dr. Roach, we have a lot of young people who are just coming out of a really rough last 2.5 years, trying to find their footing, their financial footing, maybe in a job market. Do you have any advice for those young folks? Heck, even for the not so young folks trying to find financial footing right now?
Sure. So pay off anything that's variable interest rate. If you have anything that's a fixed interest rate, that's not going to go up with any movement that the Fed does. So if you have the chance, your credit cards, anything that can move around, that's what you would pay off first. And then I'd add to that we're seeing one of the most historically tight labor markets out there. So this is good for you in job prospects. If you're looking to change careers, if you're looking to join a new industry, this is when firms are hiring and you're facing just the best job market you can see from a job participant standpoint. Now, if you're an employer and you're looking to hire, you're competing with other firms by offering higher wages, by offering better benefits. And so that is part of what might be driving some of the inflation numbers we've seen. But frankly, if you're entering the job market or if you're kind of midway through it, like maybe I am, this is a good time for you.
Dr. Doffenbach, you mentioned earlier in our conversation the year 2023, we might see some improvement. So maybe we have another year of supply chain issues, higher prices at the grocery stores, higher prices at the pumps before things start to get better. What do you think?
Yes, I think that we're maybe seeing a topping out in oil. I'm starting to see more dialogue, more discussion that maybe we have peaked out here and that we shouldn't anticipate much more in the way of price increases. So that would be a stabilizing impact. Housing markets are tending to weaken somewhat from here with these higher rates, and that should help quell that market somewhat. And I think as well that we have to recognize that ultimately the economy does better. I know we were talking a little bit earlier about, do I get out of the stock market now? Well, not if you're young. You got time. It's going to bounce back.
Just for clarification, when you say when you're young, let's put an age on that, doctor.
When I'm young, an age when you're young.
When you're young for your retirement,
Well,
but when
yeah.
you need to start
From my
life.
vantage, everything looks young from this perspective. But no, I think anybody that's even in their 50s doesn't need to be really all that concerned. By the time they're retiring, the economy will be well back on track.
One thing maybe to add to that is we are actually seeing in labor market data a lot of unretirements, a lot of folks who were in their upper 50s, early 60s who might have left the labor market mid-COVID, who are now deciding to re-enter into the labor market, which is, again, another sign of a very healthy labor market that has a lot of opportunities out there.
All right. I want to have a quick round robin, a quick last word from each of you. If you're giving your mom some advice, your sister some advice, your brother some advice about what to do next. I'm going to start with Dr. Keene. Final word.
If you're worried about a recession, you're hearing the talk of a recession, the labor market's really good. Look for additional opportunities to get work now. Any way that you can put some money away aside. There's opportunities now. If we don't have a recession and everything's fine, you've built yourself up a nice little nest egg. If you do, you've got some security to fall back on.
Dr. Roach.
First, I'd say stick to your plan. I always advise people that they do their saving at the beginning of the month. That way they've already allocated it out. Maybe don't look at what's happening in the stock market every day because frankly, unless you're retiring tomorrow, today's numbers don't matter. And then two, what options do you have for yourself to hedge for financial issues in the future? Maybe you buy a more fuel efficient car or an EV. That's one way to hedge against high gas prices. We saw a lot of folks jump into Suburbans and large trucks over this last few years. just because prices were low, maybe not the best call.
And Dr. Doffenbach, close us out.
Well, I'd just say that Oklahoma has a big place in the national economy with the situation we're seeing in energy now, and let's look to harness our resources to help solve those problems, and feel optimistic, particularly about the Oklahoma economy in that regard.
All right. I'd like to thank all of you. Wonderful insight and advice from all three of you for all Oklahomans. Thank you for your time.
Thank you.
Thank you.